Hello, everybody. Today we will talk about globalization. So, what are some of the drivers of globalization? We will talk about drivers of globalization, as well as the changing nature of global economy. We will talk about the argument or the debate over the impact of globalization, whether it's good or perhaps not so good for some populations. And finally, we will talk about the process of globalization and the opportunities and challenges associated with management practices when it comes to globalization. Now, let's talk about the drivers of globalization. What drives globalization? Why are we where we are? What were the forces that drove the world market to be in this globalized era? Well, we see there is declining trade and investment barriers that have benefited globalization. And in this case, we see international trade. So let us talk about what is international trade and what is foreign direct investment. Well, international trade is when a company or a firm exports goods or services to consumers in another nation, another environment, another continent. And FDI, or foreign direct investment, is when a firm invests resources in business activities outside of its home country. That's what we call foreign direct investment. In a way, international trade refers to the exchange of goods and services across national boundaries. So international trade requires the least commitment of risk to the company's resources. A company can use intermediaries to send products abroad and to bring products from abroad to the home market. International trade is perhaps the most inexpensive way of testing your product in foreign nations, in foreign markets. Trade in goods and services and the value of foreign direct investment have all been growing faster than the world output. More firms are dispersing production processes to different locations around the globe because they can find factors of production cheaper or closer in those markets. Economies of the world nation states are becoming more intertwined, and the world has become significantly wealthier over the past 2 decades as a result of globalization. There's also technology, which has been a major driver of globalization, which has enhanced actually communication, right? So think about communications in today's world. They seem to be instantaneous between different suppliers, different companies, and even different customers across the globe. And the internet nowadays is a major driver of globalization, which all of us are involved in. More than half of the world's population seems to be existing users of the internet. So that means a lot of opportunities for those who don't have access to regularly using the internet. Global e-commerce sales are around $4 trillion annually nowadays. So the internet acts as an equalizer, regardless of whether you're a small company, a big company, or a medium-sized company. Chances are you have equal opportunities to sell your products or to source suppliers all over the globe using the internet. The transportation technology like commercial jets, super freighters, and containerization have all shrunk the globe, made it smaller. There are many implications, obviously, for globalization of production, such as locating production in geographically separate locations, which have become very economic or much cheaper for most companies. Cultural distance has been reduced and has brought some convergence of consumer tastes and preferences. As a result of modern technology and communication improvements, we're seeing a changing world output. For example, if you look at the United States in 1960s, it accounted for about 38.3% of the world output. However, 60 years later, in the year 2020, the United States accounted for about 24.7% of the world output. So this reflects the faster economic growth of several other countries like China, for example. China and the BRIC countries are growing very, very rapidly. It is forecasted that developing nations can account for more than 60% of the world economic activity by the year 2030. So investing in these developing countries might be fruitful for those who have a little bit of extra money to take advantage of in today's global world. As the barriers to the free flow of goods and services fell, non-US companies have increasingly invested across national borders. Beginning in the 1970s, the European and Japanese companies started to shift labor-intensive manufacturing operations from their home markets to developing nations where labor costs were much lower. In addition, many Japanese firms invested in North America as well as in Europe, often as a hedge against unfavorable currency movements and the possible imposition of trade barriers, which happens to take place due to political differences at times. So as we're looking at the foreign direct investment outward stock as a percentage of the gross domestic product for a country, there seems to be a striking increase in the outward stock of FDI over time, at least during the past 25 years. The implication is that increasingly, firms that are based in a nation tend to depend for their revenues and profits on investment productive activities in other nations. So countries are depending on other nations in order to have sustainable profits in production for their workforce. Also, if you look at the foreign direct investment inflows between 1990 to the year 2020, we see a pattern here between developing economies and developed economies. The histogram shows two important trends. One, that the long-term growth in cross-border flows of foreign direct investment that has occurred since 1990. And second, the increasing importance of developing nations as the destination of foreign direct investment. So developing nations that are safe seem to offer good investment opportunities for international investors. So the national share of the largest 2,000 multinational corporations in 2019 look very different from the previous decades. 29% of these companies were housed in the United States, 15% in China, 11% in Japan, 4% in UK, and then you can look at South Korea, France, India, Canada, Germany, Taiwan, and other nations have actually been producing some very successful multinationals that are doing business across the globe. These shifts in representation of powerful multinational corporations in their home bases can be expected to continue for the decades to come. More specifically, we expect that even more firms from developing nations will emerge as important competitors in global markets, further shifting the axis of the world economy away from North America and Western Europe and challenging the long-term dominance of companies from the so-called developed world. In other words, we're hoping that the globalization of products are actually helping more and more nations to create more jobs for their citizens and also to benefit from the opportunities that exist in today's global market. So in this changing global marketplace, we're seeing more and more multinational enterprises from different nations, from different continents. A multinational enterprise, or M&Es, any business that has productive activities in two or more countries. Over the last 50 years, two notable trends in demographics of the multinational enterprise have been the rise of non-American multinationals and the growth of mini-multinationals. In 2003, about 38.8% of the world's 2,000 largest multinationals were American firms. However, in 2019, only 28.8% of the top 2,000 global firms were American multinationals. So it's a drop of about 201 firms over about 16 years. So the rise in mini-multinationals basically means we're seeing a growth in the number of medium and small-sized businesses that are able to compete across the globe. The internet is actually lowering the barriers that smaller firms faced in international trade in the past, and now they're able to sell products and buy supplies using internet technologies. Although most international trade and investment is still conducted by large firms, many medium-sized and small businesses are becoming increasingly involved in international trade and investment all over the globe. So therefore, we see there has been a rise in mini multinationals. So what do we mean by the changing world order? So the changing world order basically refers to a period of history which shows dramatic changes in the world political thought, in the balance of power, international relations among different countries and different continents, or the shifting power among different nations and even regions. Nonetheless, there are going to be anti-globalization protests all over the globe. The anti-globalization protests began actually in 1999 at the World Trade Organization meetings. Protesters are now typically showing up at many of these major meetings of global institutions, whether it takes place in the US or other foreign countries around the globe. These protesters believe that globalization causes detrimental effects on living standards, wage rates, and even the environment that we live in. Of course, research and evidence shows that these fears by the protesters might be somewhat exaggerated. The reality is that while some of the rich citizens of the developed world may have the luxury of mourning the fact that they now can see McDonald's restaurants and even Starbucks coffee houses on their vacations when they go to exotic locations like Bangkok of Thailand or Ho Chi Minh City, or formerly known as Saigon of Vietnam, there are fewer complaints which are heard from citizens of these various locations around the globe who actually welcome the higher living standards that progress or globalization seems to be bringing to them. Critics of globalization argue that falling trade barriers allow companies to move manufacturing activities to countries where wage rates are much lower. In other words, it destroys manufacturing jobs in wealthy and advanced economies. So some of our colleagues, for example, have lost their jobs because their jobs moved to India, moved to Vietnam, moved to China, or moved to Latin American or Caribbean countries because wages were a little bit cheaper there. So some of the services can also be outsourced, which contributes to higher unemployment and lower living standards in the home nations, where the job losses actually get transferred to other nations. So supporters of globalization argue that companies can reduce their cost structure and consumers ultimately benefit in all corners of the globe. Research and data actually suggests that the share of labor in national income has declined over the past 2 decades. The share of national income by skilled labor has actually increased. However, unskilled labor experienced a fall in income, but not necessarily a fall in the standard of living because we've had economic growth. The weak growth rate in real wages for unskilled workers is probably due to technology-induced shift within advanced economies. Now, keep in mind that technological change has actually a bigger impact than globalization on declining share of national income that is enjoyed by labor in today's environment. Critics of globalization argued that labor and environmental regulations actually increase manufacturing costs. They state that the lack of regulations can actually lead to abuse of workers, and firms move production in nations that do not have too many regulations so they can get their products faster with less cost. On the other hand, supporters of globalization argued that tougher environmental regulations and stricter labor standards go hand in hand with economic progress. So free trade leads to less labor exploitation and less pollution. And these supporters of free trade tend to point out that it is possible to tie free trade agreements to the implementation of tougher environmental labor laws in less developed economies. And also, supporters of free trade argue that factories based in Mexico are now cleaner than they would have been without the passage of NAFTA between the United States, Canada, and Mexico. Regarding national sovereignty, critics of globalization argue that there has been a shift of power away from national governments toward supranational organizations like WTO, European Union, and the United Nations. On the other hand, supporters argue that the power of supranational organizations is somewhat limited to whatever the nation states collectively agree to grant them. And these organizations only exist to serve the collective interests of the member states. And the World Trade Organization is actually a favorite target of those who attack the headlong rush toward a global economy. But many economists and politicians maintain that the power of these supranational organizations, such as the World Trade Organization, is actually limited to whatever nation states collectively agree to grant them. While critics argue that the gap between the rich and the poor has actually gotten wider, it has actually been due to totalitarian governments, poor economic policies, corruption and lack of property rights, expanding populations in many developing countries, and also burdens of debt, which accumulates interest on a day-to-day basis. Supporters of globalization argued that lowering barriers to trade and investment actually promotes free market policies, which tend to benefit all nations. Let us look at the world population that has been living in poverty over the past 3 to 4 decades. The data from World Bank for 1981 to 2015 shows that a percentage of the world population that is living in poverty has actually declined substantially over the last 3 decades. And we hope that part of this is due to the globalization of the world markets. So hopefully, as we continue toward the global market, more and more people will become prosperous and benefit from the global marketplace. In summary, we can say that we need to manage today's global marketplace. We need skilled international managers who can effectively function in the context of different markets, different demographics, and different tastes and preferences in the world's nations and continents. Now, any firm that engages in international trade or investment is considered to be an international firm. So managing international firms and businesses differs from managing purely domestic businesses. Because countries are different, the range of problems is wider and problems are more complex in international arenas. We must find ways to work within limits that are imposed by the local governments in each nation or each region. Transactions internationally involve converting money into different currencies back and forth, and those currencies tend to fluctuate, obviously, sometimes minute by minute, sometimes hour by hour, and day to day. So ultimately, we can say that as organizations increasingly engage in cross-border trade and investment, managers need to recognize that the task of managing international business differs from that of managing a purely domestic business in many, many ways. At the most fundamental level, the differences arise from the simple fact that countries are different. Countries differ in the cultures and political systems, economic systems, legal systems, and levels of economic development. As global managers, you need to understand them and effectively manage them. In summary, let me emphasize that as global managers and professionals in your fields, you need to understand the pros and cons of globalization, the principles of international trade, as well as the skills that are needed to effectively manage every department, every operation toward win-win outcomes for all relevant stakeholders. You can do it. Good luck.